Oh, good afternoon. Oh, yes, that's better. My name's Ross Buckley. I'm the CIFR King and Wood Mallesons Chair in International Finance Law at UNSW. It's my pleasure to be the chairman of this session this afternoon, and we are looking at resilience, which comes at the beginning of the Financial Systems Inquiry report for a very good reason. I think if we don't have a resilient financial system, everything else that follows is fairly problematic. The way this afternoon is going to work, we have 4 presenters, and they will present from the little podium up behind me for 10 or 12 minutes each, maybe 12 minutes each, and that will leave more than half the time for a discussion. For the discussion, we are joined by 3 other panel members to bring even more expertise and experience up onto this table. But I really do want to get you people involved after the presentation. I really do want you to have your opportunities to ask the questions. Now we have the full descriptions of our panel members are in the material, so I won't go into it in detail, and I will just introduce people very briefly. Immediately to my left is Kevin Davis, who of course you all know and really needs no introductions at all today, given the role he's played in the inquiry and our day-to-day. Next to him is James Cummings. James teaches this stuff at Macquarie University. I've known James for a number of years now, and he's going to be our lead-off speaker. Next to James is Alden Tobbs, who's Chief Risk Officer for the Commonwealth Bank. Alden is on our roundtable panel. Next to him is Aidan O'Shaughnessy, who's Director of Policy for the Australian Bankers Association. To my right, going the other way, is Ian Patterson, a partner at King & Wood Mallesons, who specialises in banking and finance law. Next to him is Mikhail Anufriev, who is an Associate Professor of Economics at UTS. And next to him, Valentin Pinchenko, who's an Associate Professor of Economics at my place, University of New South Wales. So without more ado, I'll just say a few words about resilience, because sometimes I think the job of academics is to be troublesome. It's not our job to make people comfortable. It's the job of people in the real world to make other people comfortable. Our job, if not to be turbulent priests, is at least to be sort of troublesome academics. So what each of you have on the table, if you're suffering from insomnia and you want to take home an insomnia cure tonight, is a paper that I've written with one of my colleagues on this subject of resilience. And I don't want to take this too far because I don't want to undermine what we're doing today. But all of the financial reforms post the global financial crisis have used the word resilience. It's right up front as an explicit goal of Basel III. Resilience is something we always say we're trying to enhance of a financial system. The reason my paper is troublesome is it argues that we don't tend to know what we mean when we say resilience, and what we really mean is robustness or strength and not resilience. And I got involved in running a resilience network of thinkers for a group called Australia 21 about 8 or 9 years ago. Most of the people on that were CSIRO scientists. And those people in the ecosystems context have done a lot of work on what makes nature, ecosystems in Australia, resilient. And the way they define resilience is the capacity of a system to withstand external shocks and regain its function, and to the point that it can keep operating, or if it can't regain its function, to transition to a new equilibrium where it can function. That's a sort of scientific and really a social definition of resilience. That's what we mean when we talk about a human being being resilient. If you're a steel worker in Port Kembla and the steelworks close and people say you're resilient, it's because you transitioned to a new equilibrium. You went and got new skills, retrained, and got yourself a new job, and if you're not resilient, you've stayed on the dole queue. The scientists are very clear what they mean by resilience, and in the financial sector, we have a very good example of that sort of resilience, and it's the hedge funds sector. In hedge funds close all the time. The average hedge fund only exists for a relatively short number of years, but the entire sector keeps going just fine. The collapse of funds doesn't damage the operation of the sector. People make lots of money in the sector, they lose lots of money. It keeps fulfilling the function it fulfills, and people are broadly happy with it. When we leave hedge funds and we come to banks, we use the word resilience, but we're not at all comfortable with the idea of a major bank transitioning to a new equilibrium, right? That looks like Northern Rock or Lehman Brothers, right? That doesn't look like what we mean when we talk about a resilient financial sector. So just to be troublesome, I want to sort of lob a little hand grenade out there, which is to argue that when most of what we say we're questing for is resilience, I suspect what we're often really meaning is robustness. What we want is to make our banking system incredibly strong so that it can get through anything. And that's the first piece of my little intellectual puzzle. I haven't done the really hard work, which is to then work out, well, what would a truly resilient financial system look like? I'm not here arguing that we want wobbly banks, right? I'm not arguing that we want banks with the life expectancy of hedge funds, but I do think there's an interesting thing going on when we use this term resilience, because we use it in finance in a different way to anywhere else. But anyway, that's my little piece. I don't want to undermine everything we're doing today. What we have done today is there's 8 recommendations in the report on resilience. We've given each speaker 2 recommendations, and I'll hand over to James Cummings from Macquarie to address number 1 and number 6. Number 1 in some ways is the hot one. I noticed it was the one we got the question from the journalist on before lunch, or after lunch, capital levels. So over to James on those points. Thank you.
Good afternoon. Yes, thank you, Ross, and I'll outline economic issues and implications around recommendations 1 and 6 in the Murray final report. Those being that Australian banks be required to maintain higher capital levels, and that we maintain the ex-post funding structure for Australia's deposit guarantee, also known as the Financial Claims Scheme. Now, capital regulation, just to set the scene, potentially involves a trade-off between reducing the risk of bank failures and more expensive access to credit intermediation by households and businesses. The risk of bank failures, evidence out there put around by the IMF demonstrates that banking crises occur in a given country on average once every 20 to 25 years. So that's where that benefit comes from, potentially in increasing capital requirements. The costs might occur if, for example, a tax disadvantage in increasing a bank's equity as opposed to debt in its capital structure come at a tax disadvantage that's not completely offset by reductions in costs of financial distress, private costs from the bank's point of view. Now, there's international literature, empirical literature out there. The studies mentioned on that slide there by Cashiap and company based on US banking data, Miles and colleagues based on UK banking data, which says that actually the costs of the funding costs for banks of considerably higher capital requirements are very small relative to routine fluctuations in interest rates, adjustments in funding costs that occur in relation to changes in credit spreads, changes in monetary policy and the like. Now then, if we've got that international evidence out there, why might we look a bit further? Why do we want to investigate and work out whether this is going to be the case for Australia if we do adopt the recommendation put by the Murray inquiry? And there's 2 reasons why Australia might be different. One is that we have a dividend imputation system. We're one of the few countries in the world that does. But that's fine. That potentially kind of levels the playing field in terms of the cost of equity relative to the cost of debt. But if the marginal investor in Australian equity is an international investor, and we know that international investors are unable to access the benefit of the imputation credits, that potentially exacerbates the disadvantage in increasing equity in a capital structure relative to debt. And on that point, I referred to a paper by Sal, also Jeff Warren, that actually does provide, and this is somewhat contentious evidence at this point, provides evidence that the marginal investor in equity is an international investor. Second point we want to look at in Australia is, and the IMF has noted it in its 2012 report, is that we do have a concentrated banking sector in Australia. We have about roughly 3/4 of assets maintained within the big four banks. We don't have any global systemically important banks, of course, but we do have 4 DSIBs, domestically and systemically important banks. And the implication there is that with a concentrated banking sector, that might increase the value of implicit guarantees. Implicit guarantees potentially lower the cost of debt and potentially provide a disadvantage to equity relative to debt in terms of the bank's funding decisions. Now, as if you were my Finance 101 students, I'll just go back to 1958 and talk about the Modigliani-Miller capital structure irrelevance theorem. And of course, those guys that we've all heard about, they're saying that a bank's capital structure will actually be irrelevant to the value of the bank based on a certain number of quite extraordinary assumptions: no taxes, no information asymmetries, no cost of capital raisings, and so on. And in a way, the calculations that were included in Chapter 1 in Murray's final report are quite conservative in terms of their estimates of the impact on banks' funding costs of higher capital requirements, because they take no account of the Modigliani-Miller idea that there's a de-risking in both the equity issues and the bond issues that the bank has out there when you shift away from more debt to a bit more equity in the capital structure. Now, Officer has demonstrated through an equation, which I won't go into the details of, that dividend imputation is important to working out the overall average cost of funding a bank in Australia. Now, Sue Wright-Knight, Macquarie University, have run some numbers, and we have actually taken into account the de-risking that Modigliani and Miller were talking about. We're also going to take into account in our calculations Australia's unique taxation structure. And we refer to the extent to which corporates and banks distribute earnings that they make in the form of fully franked dividends. Now, updated statistics provided by Hathaway suggest that corporates generally distribute about 70% as a ballpark of their earnings as fully franked dividends. For the banking sector in recent years, it's been more like about 70 to 80%, so that 70% estimate is fairly conservative. Other research, and this is Beggs and Skeels 2006 and a paper around about 5 years ago that I was involved in, suggests that once investors have franking credits, that they actually, on average, value those credits at anywhere between about 50 and 60% of face value. Now, that's curious. We know that domestic residents can claim imputation credits as a refund on their tax returns. We know that international investors have no access. They can't use them. So how is it that the average investor can get, market prices are telling us that the average investor gets roughly 50% of face value? Well, it appears that that over time, on average, it's 50%. So it could just be who is the marginal investor in the market for a bank's equity on any given day of the week, on any given month of the year. On average, the empirical research coming from academic studies is saying about 50% of face value. Okay, we put that into our calculations and we look at a scenario where there's a doubling in banks' equity included in their capital structure. And for argument's sake, the scenario, the example we look at is increasing a bank's equity from 5% of total assets to 10% of total assets, and we come up with an estimate that that's going to have an impact overall of 8 basis points on a bank's overall funding costs. So when you take that de-risking into account, our estimates are saying that tax is actually less important than suggested by the resilience chapter of the Financial System Inquiry. Okay, now if it's not really tax that's giving us the explanation, then let's look at something else. Implicit guarantees on a bank's debt, they might also matter in terms of the implications of higher capital on a bank's funding cost, because if a bank's debt is implicitly guaranteed by government, that reduces the cost of debt. That potentially again provides a disadvantage to a bank that moves away to debt towards equity. And evidence there is suggesting, and this is a study by Ueda and Ueda de Moro, which is quite recent in Journal of Banking and Finance, And they look, of course, we had our wholesale guarantee came in during the financial crisis, and wholesale debt could be guaranteed at a fee between November 2008, March 2010. But this study in Journal of Banking and Finance actually looked at it at the end of 2007, before that wholesale guarantee was introduced, and was saying that for Australian banks, they had 11 Australian banks in their sample, and so you're looking at on average across the large banks and the smaller banks, on average that implicit government support at that point in time was worth between 2 and 3 ratings notches, as noted there. Now, when a bank issues a 5-year bond into wholesale markets, on average, again, looking at 80 years of data on the funding advantage available at different ratings notches, that implies average implicit support of roughly 60 basis points when a bank issues a 5-year bond into the marketplace. Now, also on the topic of guarantees, and just taking the opportunity to link it to the other recommendation in the FSI inquiry, which is that we maintain our ex-post funding structure for the financial claims scheme. The financial claims scheme, of course, was introduced in October 2008. One implication of the scheme in its current structure is that no failed bank will ever have contributed to any expenditure that's incurred through that scheme. Any expenditure is to be recovered through asset liquidation recoveries. There is an option there for a government to recoup expenditure on the scheme by imposing a levy on, to make up any shortfall with a levy on remaining banks. But we consider in the work that we've done on this topic that would be highly unlikely that a bank would exercise that option amidst a systemic banking crisis due to the potential pro-cyclical effects in terms of exacerbating, in effect, the banking crisis by imposing a levy at that point in time. Okay, so in summary, based on the existing international evidence, our work in reviewing that literature is suggesting that higher capital requirements will result in a small long-run increase in the borrowing costs faced by bank customers. The 2 reasons that we attribute to that, to some extent the tax advantage of debt is reduced by our dividend imputation system, but it's not completely eliminated because the franking credits are not valued at 100% of face value. The evidence also suggests that Australian banks continue to benefit from implicit government support on their debt issues, and that also comes into play. Importantly, we look at that international evidence that's provided by the likes of Miles and Cashiap about the de-risking effect, the idea that when you include more equity in the capital structure, that reduces the cost of both equity and debt. There's no obvious reason that we can see why those kind of offsets on the cost of equity should not be available in Australia. Those effects, though, remain to be substantiated by empirical research in Australia, and I'd like to be part of the charge in actually pursuing that agenda this year. For those of you who would like more detail on the issues and implications that I've just run through, Sue Wright and I, both Macquarie University academics, have an issues paper that we've put up on SSRN that's available there, so we'd encourage you to go online and download that and come back to us with any questions about it.
Thank you, James. Thank you very much. Would we like to take maybe 2 questions from the floor before we move to the next speaker? Just because I'm aware by the time we get to the end, some of you may have forgotten the questions you have for James, given he had the unenviable task of going first. I thought that was an excellent presentation, mainly because you confirmed nearly everything I think in this space. So that's always encouraging. Doesn't mean you're right. Are there questions from the floor at all? I must say, personally, I'm concerned about the murmurings I hear, people expressing dissatisfaction with the dividend imputation scheme and arguing maybe it should be taken away, mainly because what I notice in America, the absence of it means that debt is strongly preferred to equity, and I think if you want to run a stable economy, you don't prefer debt. If you can find a way, you prefer equity. Equity is a lot less destabilising than debt, so I'm really concerned by these murmurings. Anyway, okay, without more ado, let's move on to one of the authors of the report, Kevin Davis.
Thanks very much. I've got the task of talking about recommendation 2, which is the better alignment of the IRB and standardised risk weights, and also recommendation 8, which was about leverage or borrowing in superannuation funds. I probably should just make a preliminary comment, that is, Ross, we tried a few different names for that chapter. I'm not sure we ever tried robustness, but I'm not quite sure at what stage it got changed to resilience. But anyway, it might have been you said people were, or maybe it was Ian said people are going to analyse, you know, the words in the report at various stages, and you've already started. So yeah, okay. There's lots of different ways we could have described it. Okay, recommendation 2. I'm sure people are familiar with, or you've got a copy in front of you, I guess, was that there should be a better alignment of the risk weights for residential mortgages between the IRB and the standardised approach. Now, this is in the resilience chapter, but you'd have to accept that a large part of the rationale is to do with competition, an issue of competitive neutrality between the large banks and the smaller banks. And it fits, however, in the resilience chapter because there are questions about the incentives it gives in terms of risk management for small banks, or risk-taking for small banks, that to the extent that they are squeezed out by the capital advantage that larger banks have in the funding of mortgages, that they may be induced to go towards higher risk activities. Having said that, that gets back a bit to what James was saying about the Modigliani-Miller type argument. That argument is based on the assumption that there is a capital advantage, there is an advantage in funding costs if your capital ratio is lower. And I agree with the perspective that there is actually a capital advantage, but it's because of the fact that there is an implicit guarantee which makes the cost of debt and deposit financing cheaper. And to that extent, going back to James's point, if you increase the capital ratio, you're actually reversing a distortion that's there because of the perceptions of implicit guarantees. Anyway, our recommendation about better aligning the IRB and the standardised approaches has sort of been somewhat overtaken by the Basel 3++ or Basel 4 consultation papers that came out at the end of last year. We were aware that there were, that Basel was looking at the general issue of the standardised approach without knowing the details, but I think it's fair to say, as Wayne Byers has already said today, that in a sense our recommendations in the Basel consultation papers are all moving in the same direction. You know, we were of the view that one wants to have risk sensitivity in capital requirements, you know, but we weren't sure that the existing arrangements for the IRB versus the standardised approach were actually appropriate in that regard. I think it's interesting to note that the residential mortgage lending portfolio is the one where the most significant difference arises compared to other parts of bank lending. And that's sort of a bit weird, isn't it, that given that Basel is all about levelling the playing field for internationally active banks across, you know, across the globe, yet the area where it's had the biggest effect has been in the residential mortgage lending, which of course is where domestically oriented institutions are well focused. And I guess I'd put my hat on as an ex-credit union director and say it's not clear that residential mortgage lending is all that difficult or hard to manage the risks, even though a whole lot of people around the world have really screwed it up. You know, there are some fairly straightforward ways to keep the risk in a residential mortgage portfolio fairly low, loan to valuation requirements, debt repayment ratios and so on. Anyway, our concerns were that there was clearly a consequence of the differences in the risk weights. You could see it in what was happening in terms of the share of the larger banks versus the smaller banks in residential mortgage lending. And our concerns were the impact on the potential demise of smaller competitors and the fact that they might be forced into higher risk lending in the mortgage area. How big is that effect? And this comes again back to what James was talking about. How big is the effect on the cost of capital, of differential capital requirements, and I think we came up with a figure of about 10 to 15 basis points, I think from memory. I haven't gone back and checked it, and clearly the numbers you get depend on the assumptions you put in to the analysis. But there was clearly a differential effect there. Given that one recognises there is a differential between the two approaches, there were then two options, maybe there were more, but two main ones. Either increase the risk weights in the IRB approach or reduce the standardised risk weights. That latter one was in a sense ruled out, at least at that stage, by the fact that that would have put Australia in violation of the Basel capital standards. Also, it doesn't seem sensible when everyone's a bit worried about housing mortgage loans and housing markets to be reducing the risk weights associated with that. So it was pretty much a lay-down misere, I think, that one would argue to increase the risk weights in the IRB approach. Having said that, it still seemed appropriate to keep some incentive for institutions to try and become accredited as IRB banks, that the process of improving the risk management systems and so on is worthwhile. So we thought it was best that there was some differential to keep that incentive, but nowhere near as much as currently. I guess we also made some comments in the report on the IRB accreditation process that APRA has up to now, I think it's still the case, essentially required that you're either all IRB or no IRB, that you couldn't get accreditation for some bits of activities, and we raised the issue as to whether that all or nothing approach was an appropriate one. And we also, I think, made some comments about the extent to which there were differentials in the risk weights in other portfolios that might be worth looking at. But clearly the main issue on that one was the residential mortgages. If I turn to recommendation 8, which was to stop borrowing by superannuation funds, I think underpinning this are two factors. One is, if you ask yourself the question, what are the big risks to a financial sector? Leverage and liquidity. I think one of the things that helped us in the global financial crisis was a large part of our financial sector wasn't leveraged. Superannuation funds didn't have leverage, and therefore any shocks to the system went straight through to the balance sheets of the individuals. And of course, these are long-term balance sheets, and therefore their impact was the impact of those shocks, I think, was moderated by the fact that we had a large unlevered superannuation sector. The other piece of thinking is that, again, our recommendation, I forget the number, but the first one in the superannuation and retirement sector was that superannuation should be all about providing retirement income, not about wealth accumulation, wealth management per se. And what people were doing in the Smurf space was essentially trying to use leverage for wealth management, wealth accumulation. Clearly, using leverage in superannuation increases the risk. It's not clear that's consistent or appropriate in superannuation. Yes, there are all sorts of problems in a recommendation that says no explicit leverage, because we know that company shares are already leverage claims on the assets of the company. We know that there can be all sorts of inbuilt leverage in warrant products and so on. So you're always going to have fancy financial engineering trying to get around these things, but at least we felt that preventing leverage, explicit leverage in superannuation funds made sense. Also in that regard, it sort of links a bit also with the consumer outcomes sector, that one of the dangers, I think, in this space is that there are lots of people out there, you might call them property spruikers, who would be trying to attract self-managed super funds into levered investments in the property area. That's obviously got potential hairs on it in terms of some of the things we've seen in that area over times past, and therefore it helps solve another potential problem. Another issue is that the using leverage could potentially help to circumvent the contribution caps on superannuation, that someone could increase the size of their portfolio via leverage, hold the assets in there until retirement, and end up with a much higher level of assets and superannuation than was actually really intended, given the nature of the contribution caps. I guess the final point I'd make would be that, and this sort of gets back to the interrelationship between super and tax, and that is that it's not actually obvious that it makes sense to lever an asset within superannuation rather than outside it. The benefits of levering depend on the difference between the tax rate on the income and the rate on tax deductibility of the interest. If you're outside of super, 45 versus 22.5 if you're on the 45% tax rate, because capital gains are only taxed at half the rate. In super, 15% is the normal tax rate. It's only 10% in terms of capital gains. The big difference arises in superannuation from buying assets and holding them until the retirement phase, when you've got the interest tax deductions all the way through the accumulation years, and then sell the asset in the retirement phase and pay no capital gains tax. So one of the points I would make is that if the government were to do something like reintroduce a tax on earnings in the retirement phase, that could solve the problem anyway, rather than the need to prohibit leverage in the accumulation phase. But I think on balance you should do it anyway. Thanks.
Thank you, Kevin. Thank you very much. And our speakers are admirably sticking to time. A couple of quick questions for Kevin from the floor. One question I have for the audience: is there anybody here who thinks that leverage in superannuation is a good idea? Does anybody, the second of the recommendations Kevin looked, is anybody willing to argue that we should allow borrowing in superannuation, and what the policy goal is that's being achieved by that? Don't be shy. Maybe you work for the superannuation industry.
There's no property spruikers here.
There's no property spruikers. The reason I ask the question is I wonder whether that's possibly one of the recommendations of the Murray report that will get implemented relatively quickly. Peter Mason referred to it this morning. It seems to me just, if superannuation is supposed to do what it says it's supposed to do, letting people borrow in it doesn't make policy sense in terms of taking, really it's there to take pressure off the aged pension, surely. It's there for retirement income. And this is just one of those things that's crept in. And, you know, I noticed the Sydney Morning Herald goes to the president of the Real Estate Institute for comments on this in the articles. It's extraordinary. I mean, you know, anyway, I'll stop at that point before I get carried away. Settle down. And I will turn the microphone and the stage over to Ian Patterson from King & Wood's Mallesons. Thank you, Ian. Ian's going to address recommendations 3 and 5. Recommendation 3, to kick off, being loss absorption and recapitalisation capacity. So, in other words, bail-in-able instruments, that type of thing.
Thank you, Ross. Good afternoon, everyone. Yes, recommendation 3, popularly referred to as bailing in senior debt. If the bank is in need of resolution, some or all of its senior debt gets turned into ordinary shares or written off. Plenty of proposals to do this overseas, and it's one of the recommendations of the inquiry that we think about it here. I want to make 3 points about this proposal. First of all, it's not self-evident, I think, that the existence of bail-in powers actually achieves their objects of reducing moral hazard or actually making the system more stable. However, if we're going to have it, I think my second point is it must operate clearly and fairly, and particularly in Australia there are some difficulties to achieving that. Not insurmountable, but they need to be recognised. The third point is, I think, in terms of how you implement it, it will prove to be much more preferable to have a contractually supported, freely bargained for category of Tier 3 or total loss absorbing capital, rather than a crude imposition of a mandatory bail-in on all senior debt. I'll speak briefly as to each of those 3 points. First of all, should there be a bail-in power? Well, there are 2 common reasons for it. I call the first the preventive reason and the second the fair distribution of loss reason. The preventive reason is that if we implement this, somehow this of itself makes the system more stable because people dealing with The second reason, that what I call the fair distribution of loss one, is that it's just not right to call upon the taxpayer to bail out banks. It's the people who've dealt with banks who are in a better position to do that. Now, you might query, I think, the compelling nature of each of those arguments. In relation to stability, if I simply put a power into the Banking Act to allow a prudential regulator to order a bail-in, does that reduce the expectation that there's public sector support should it get into difficulty? Well, it might, but it's not just about powers, it's about the perception of whether they will be exercised. And for government, it's also a question of whether in the particular situation that they face, they could actually exercise them. And I think there's a world of difference between perhaps a difficulty in a single institution compared to where there is a systemic crisis. Second, it's said that having this reduction in an expectation of public sector support somehow tempers the tendency of management to engage in risky behaviour. To which you might say that if somehow I'm less confident that the government will bail me out, but I've now got a mechanism to see that my senior bondholders will bail me out, I'm less likely to take risk. I've never quite seen the logic in that. The third one, the fact that the creditors are exposed to more risk now through the structure, does that mean that they will take action to discipline the bank? Yeah, arguably yes, but we mustn't forget that the disciplines of a bondholder creditor are actually quite crude. They can raise the price or they can refuse to supply credit, but their choices and actions are often driven by other factors like the availability of alternative investments. They're not necessarily going to go to say to the management, you must change your risk management policies. What about fair distribution of loss? Well, I think this rests on the premise that if the losses have to be absorbed, don't put them on society as a whole, put them on the bankers and the shareholders and the bondholders who've enjoyed the profit of financial expansion. But look, like a lot of assertions of fairness, it's not necessarily as clear cut. It works nicely if you assume that there is no connection between the citizens of a country and the shareholders and bondholders in banks. In fact, in this country, with one exception that I'll talk about in a moment, there's a very large overlap. And it discounts to some extent the fact that just keeping the financial institution going, funded as it has been, may be a matter of great public utility, and indeed, if it is true that a bail-in regime would lead to higher funding costs, perhaps it's even a rational choice for government to say, I'd rather support this implicitly and have my national deficit funded through the banking system. Anyway, statements of that kind, some people would regard that as heretical, so I'm going to just concede now that we are going to have a bail-in regime and focus on questions of how it's going to operate so as to achieve its objects and how we can get it to be fair. I might at this stage just, whoops, nope, nope, doesn't quite seem to be there, never mind. So how would it work here? There it is, thank you. There's three things that I think one needs to consider in designing a bail-in regime in Australia. You need to think about the trigger point. What's the action? What's the event that allows the regulator to step in? Secondly, who are you going to bail in? And thirdly, you've got to ask, Australian law on its own, can that do the job? Now, if we think about the trigger point, it needs to be relatively certain. If you don't have some certainty around it, then that may frustrate the regulator's ability to use it, and it certainly doesn't help in efficient pricing of the liabilities if you're not certain what the event is. You need to pick a point which is closer or further removed from traditional concepts of insolvency. The closer you go to insolvency, well, that's less costly, but the closer you get to insolvency pulling the trigger, the greater the signal to the market that it makes that you've pulled the trigger, and the greater the effect of confidence that you may have on the bank. That in turn can undermine the whole purpose of the regime. Now we come to the really interesting one, picking the creditors to be bailed in. Now I started by saying it's the unsubordinated general creditors of the bank. Now in fact there are lots and lots of classes of unsubordinated debt holders. Bond creditors, depositors, holders of bills of exchange and promissory notes, derivatives counterparties, trade creditors, employees, the tax office, the Reserve Bank. One needs to make a choice as to who gets bailed in. Now, let's work through some of the critical things that we're trying to achieve. First thing is we want the bank to keep making payments. Payments come out of current deposit accounts, so you can't go bailing them in. That's going to defeat the purpose of the exercise. How do you define what types of accounts will be protected? Do you do it by an amount? Well, that's a bit arbitrary and won't necessarily capture the systemic effects if you just start disrupting really large payments. Okay, well, second general principle, you'd think if you're going to bail in creditors, you should respect the hierarchy that would apply in a liquidation. Bail them in their order of priority. And indeed, that's an FSB principle and a good one. But let's see how that works in a moment in Australia. Third point, again, goes back to the fact we want to keep the bank going. So if it's got its essential suppliers, we want to continue to pay them. Now, when I work through the regime that we have for priority in Australia, there's an awful lot of preferred creditors. Protected accounts in Australia have a priority over general creditors for payment out of the bank's Australian assets. Absolutely unlimited in amount. It's a large part of the bank's funding is preferred. This is not just the FCS. Other particular classes of creditors, covered bond holders, derivative counterparties are effectively preferred by their netting and set-off arrangements, and no one wants to touch that. That causes other systemic issues. And when you work down to it, you find that who would you be bailing in? Well, it's basically the holders of bonds and bills, the holders of certain accounts located outside Australia, and the holders of accounts in foreign currency. There's a bit of a theme about foreigners emerging here, and I'll come to that in a moment. But let's talk a word first about fairness. If I want to go bailing in the creditors, I need to do it in a way that's fair. We actually do this in this country at the moment in relation to regulatory capital, and the common method is to do it by converting into equity. These equity conversion methods are actually very difficult to get to work in a way that is fair once you extend them up to senior creditors. And that's, I don't have time now to get into the technicalities of how those conversion formulae work, but you don't necessarily produce a result. You may produce an order of converting people, but the actual economic outcomes are not necessarily in the same order that the lowest ranking person has suffered the most loss. And you see the Europeans trying to deal with this by just saying, look, how we convert people, we'll let the regulator make up a formula at the time. It's not the approach we've taken here. Okay, economic cost. I want to go back to that point about where the bail-in creditors happen to be likely to be resident. We're largely talking about bondholders, and most of the bondholders are foreigners. I haven't got the exact statistics, but for medium-term notes, when I last looked, it's about 73% of bonds actually are foreigners. So in a bail-in situation, one's effectively throwing the loss on your foreign investors. If you're converting the instrument into ordinary shares, you're actually going to hand over large stakes of equity to foreign investors as well. And you need to work out whether that's what you want to have happen as a result of the action. Now, how exactly will foreign markets react to the bail-in power? Well, I wouldn't pretend to predict it, but I do suspect there's a very large chance we'll be charged for it. Lastly, Australian government action. Now, most of this foreign debt funding is raised in overseas markets under contracts governed by English or New York law. Now, we can pass a statute here saying everybody is reduced to equity or written off, and an Australian court will give effect to it if they're told that they must do it even to a contract governed under foreign law. But it doesn't necessarily work in a foreign country. And so anything of that nature will normally need to be a combination of not only an Australian statute saying let's do it, but also an agreement on the behalf of the foreign creditor to be bailed in, to abide by the terms of our legislation. And it's those combination of factors, the fact that ultimately your regime will be partly contractual and partly statutory, the fact that imposing it across the entire class of senior debt, I think, will be relatively expensive, leads me to suggest that the most preferable approach, if one is to have this regime, would be to set a target for what you might call Tier 3 capital or another type of total loss absorbing capital, where senior creditors have agreed that they will be bailed in, they charge a price, but there will still be other bondholders who have not made that agreement and are unaffected by the regime. That is my hasty gallop through the very, very complex subject of bail-in, and I will say that the suggestions in the inquiry that this is a complex topic and will take some a period of time to work through an appropriate regime, I think are exactly spot on. Let me go then to the second topic, the Crisis Management Toolkit. Now, we all remember the Treasury consultation paper on crisis management powers of 2012. The inquiry has recommended that we complete the existing processes for strengthening crisis management powers that have been on hold pending the outcome of that inquiry. Now, I can't even count the number of recommendations that were in that report. There were dozens of them dealing with all sorts of highly technical problems and glitches in the legislation, both the Banking Act, the Insurance Act and so forth. And at the time, response to those proposals was generally supportive or overall pretty muted. And I would say that the existing laws are indeed untidy and in need of an overhaul. So, could there be any sense in which it's a bad thing to take some of the measures that are put forth in that Treasury paper? Well, while I would broadly support an overhaul of the legislation, I do think that some of the issues or some of the proposals that were put in that Treasury paper need very careful and cautious consideration. And on the slide, I've just picked out a handful of them, and beneath each dot point there is a virtue and a vice. So, for example, in relation to groups, it said it would be a good thing that, whereas the prudential regulator at the moment can appoint a statutory manager to a bank to take control of its affairs, if the bank's part of a conglomerate group, we should be able to do the same thing to its non-operating holding company and various other subsidiary and sister entities. And then you say, well, yes, that might help resolve the bank, but since the Wallace report, a number of organisations have organised their affairs around a principle that was recognised in that report, that non-operating holding companies are a way of insulating banks from risk. So you take the non-bank business, you put it in something else, and it's supposed to be able to conduct its activities without affecting the bank, and you would think therefore that it really should be free from that sort of interference that otherwise applies to the bank. And reversing that policy, I think, requires some very careful thought. What about the statutory management framework itself? In my time as a lawyer, I have watched the point in time at which a statutory manager can be appointed to a bank move slowly further and further away from traditional concepts of the insolvency of a bank. It rests at the moment on APRA being able to appoint a statutory manager if it considers that the bank may become unable to meet its obligations in the absence of external support. That's a good. That's not traditional insolvency, but it's still got that concept. The proposal, on the other hand, was to say APRA can march in when it has reasonable grounds to believe there's a material deterioration in the ADI's financial condition that could pose a risk to depositors. What's that? A credit rating downgrade from, A to BBB plus or something like that. That's a really, really broad test and quite intrusive and productive of uncertainty. The one that got the most airing was the direction power to suspend continuous disclosure in a crisis. And here we have, as the FSI paper, or as the Treasury paper recognised very fully, a real tension between a desire for financial stability on the one hand and a desire for market integrity on the other. Now, if I suspend continuous disclosure in the interest of saving a bank, there's a public interest in that, to be sure, but equally there are people in the share market who are trading on an uninformed basis and probably suffering losses as a result. is that the policy that we actually want to have? Branches of foreign entities, another curious one. There's a gap in our law at the moment. We don't quite have the same reconstructive powers over a foreign bank branch operating here as we do over an Australian bank operating here. And it is said that, for example, if a European regulator wishes to reconstruct a European bank, it would be really good if their order just applied in Australia, or our authorities could do exactly the same thing. And for international comity, for reciprocity of treatment, that's a perfectly good idea. It does cut across the Banking Act at the moment, which says if a foreign bank goes down, the Australian assets go to the Australian depositors first. So in playing ball internationally, we've got a local policy which we would need to sacrifice. And lastly, I will just touch briefly on the financial claims scheme, security versus what I call the security versus discretion point. People refer to the claims scheme as a guarantee. It's not. It's switched on at the discretion of the minister at the time of the application to wind up the bank. It's certainly not to a lawyer a guarantee. It might be government policy perhaps to apply it at the moment, and I think the previous government indicated they may change that to make it apply automatically, but at the moment it doesn't. Now, there's no doubt if you change the law in the direction that's imposed by the paper, you make the claims scheme very much more guarantee-like. It'll apply automatically. Might be good for stability, but it's certainly a significant financial commitment for the government in an otherwise unfunded model. So and I won't, in the interest of time, I won't bother touching on the last of those points. But it just illustrates what I've tried to illustrate in those very quick grab bag of points is that there is a number of those powers which, while it would seem a reasonable thing to do at first blush, they actually require quite important and careful consideration. And that's it.
Thank you. Thank you very much, Ian. Are there any immediate questions for Ian before we move on? Anything? Yes.
Yeah. Bernard Kellerman, Banking Day. Hi, Ian. I might have one quick question. Right now, as we speak, we've got the New Zealand Sovereign Wealth Fund about to launch legal action against the bank or the bank regulators in Portugal. Two small countries, admittedly, but a great example, I think, a real-life example of how these bail-in provisions might work. And do you think that the way things are going, if we are going to follow international precedent, we would really have no option but to have bail-in in Australia if other countries are actually implementing it in their own banking systems? Do you think what could we learn from what's going on? I know the case is ongoing. What could we learn from that?
Well, I do think that if the consensus of international opinion is that a strong and healthy banking system has a bail-in regime, it would be very hard to resist that pressure internationally. I also do think that despite whatever criticisms or probings of the bail-in proposal that I've made today, I do think there is certainly a case for tidying up the Banking Act and the Insurance Acts and the like to make a much more comprehensive treatment of how you deal with that situation, which was compatible with having a bail-in power. I suppose that's the first thing. But as I've said, you need to make sure that it actually works in a proper way and without just becoming so discretionary that it will frighten people off. The second thing I would say in answer to your question is, yes, people will try to challenge a bail-in. If I am a senior bondholder and I thought I was going to get 100 cents in the dollar, or even if not that, at least a full recovery, and I think I'm being reduced to some equity stake, which I don't even think is the right equity stake, I will find some way of having a go at it. And that's why it's really important to construct the system in the strongest possible way that you can. And the strongest possible way is probably a combination. People talk about doing it by statute and then by doing it by contract. The answer is you do it by both. That's my view.
Okay, one more question or we move on? Okay. Thank you very much, Ian. But, on that last question of people having an attack at bail-in, Charles Goodhart and Emilius Agulius in the UK have just written a wonderful paper on precisely that issue, sort of holding the economists to account, saying, well, the economists always write about bail-in as if we can create this structure and then it will just be implemented. Whereas the reality is lawyers look at it and come to the conclusion, no, it won't be implemented, it will lead to years and years of litigation, and it won't be anything like you think. It won't have any sort of market calming effect at all, because you won't get any immediate certainty out of it. What you will get is a whole lot of litigation. That's another issue.